Hi, folks, and welcome to the Meaningful Money Podcast, Season 13, Episode 3. This is the podcast dedicated to helping you put your finances in order. My name is Pete Matthew, and I'm going to share with you everything you need to know and everything you need to do to secure your financial future. I'm here to help you make sense of money. Here we are once again. Great to have you with me. We're in a season about millennial finance, and really not just millennials, but anybody who's looking to get started with their personal finance journey. Just so happens that many of the millennial generation, that's those born sort of after 1980 really and before 2000, something like that, many of those folks are in the position where now they're starting to take their personal finances seriously. Now, chances are that generation, they're going to be saving and investing for a very long time. We talked about that a little bit last week, the impact of a longer life. But it's also likely that along that journey, they are not going to experience the kind of investment returns that previous generations did. Of course, we don't know what the future holds, but chances are that's going to be the case. And if it's the case, what impact might it have on their future wealth? That's what we're going to be looking at today. As usual, after the main body of the show, I'll announce a couple of things that we're working on at the minute, talk about what we're going to be discussing next week, all that jazz. But before any of that, remember this podcast is brought to you with the help of my friends at Seven Investment Management, who are specialists in something called multi-asset investing, something I believe in very strongly. They've been helping me out here on Meaningful Money since spring of 2011, and I'm super grateful to them for doing so. So please do check out what they're up to. It helps me, if you check them out and say thank you to them. So they're at 7im.co.uk. That's the number 7im.co.uk. Definitely go check them out. Now, investing giant Vanguard, one of the biggest investment companies on the planet, recently released a study which showed that returns from the US stock markets are expected to be lower in the next 10 years than they have in the past 10 years. I've read similar things about the UK and other developed markets, and if that's the case, what impact might it have on the wealth building efforts of today's millennial generation? That's what we're discussing. Remember, any notes and links from today's show, it's at the show notes, which is the only link you need to remember, meaningfulmoney.tv/MF3, that's for millennial finance, meaningfulmoney.tv/MF3, millennial finance, episode 3. Let's look at what we need to know first. Okay, first thing we need to understand what we mean by returns. If we're talking about returns going to be lower, we need to know what that actually means. The difference between saving and investing is primarily about the method in which the money grows. When saving into a bank account, you get interest paid on the money that you have saved there. It's the bank's way of paying you for the use of your money while you save it with them. All right, that's what interest is. When you invest in real assets like shares, for example, you still get an income. Now we call that a dividend. And also the value of the share itself can rise and fall. Growing your money that way, by rising usually. Now I call the combination of capital growth and dividend total return. So that's what I'm talking about when we're talking about returns on investments. It's the total return that you're going to get, the rate essentially at which your money will grow. Now, there's a few factors involved in valuing a share. For example, if the company is doing well, making a profit, if the management team is sound and forward-looking, then the share price will rise, right? Because more people will want to buy those shares. If the general sector in which a company operates is in good shape, whether that's retail, possibly not right now, retail, pharmaceuticals, or whatever, if the general sector is in good shape, then that will be good for the share price too. A profitable company will often issue a dividend, which rewards investors in the short term by paying them some of the company's profits. That's good for the share price. Obviously, that's attractive to a lot of investors. Now, these things are called the fundamentals. They are essentially the numbers, right? That and the general economic situation. These things primarily drive the long-term performance of a share. Now, overlaid on top of that is sentiment. And even if a company is profitable and well run, if enough investors think that there is reason to sell a share, then its price will fall. And if there's a general sell-off across all sectors of the market, even our well-run company, in a thriving sector, might still see its share price fall just due to contagion and general concern in the markets. Fundamentals and sentiment. These are two variables, and there's loads of nuances, obviously, as you can imagine, in each one. But together, it means that we have a chance of predicting what will happen to share prices in future. Right? The market, in inverted commas, which is a term used to describe the combined price of all shares, is like a living, breathing thing. It's unpredictable, it's temperamental at times, but what we know without question is that it is still the best place to grow money over time. Right? Share markets, best place to grow money over time. If what Vanguard are saying in that study and others are saying, if what they're saying about returns is true, that they will be lower in the future, we firstly need to understand that they don't know this for sure. Okay, it's only a prediction. They certainly know more about this stuff than I do, right? But that doesn't make them prophets. It just makes them educated guessers. It makes sense to take note, though, obviously, and then do what we can to offset the impact of lower returns going forward. In doing so, if we get surprised by higher than expected growth, we'll be really well positioned to take advantage of that. All right, so we've got to invest, even if returns might be a little lower going forward. But if they are better than expected, then so much the better, because we'll be in there. So, first thing, that's what we mean by returns, okay? How much your investment will grow and the means by which it grows. Second thing we need to know is that the world is a very big place. All right, we always need to be careful with generalizations. The Vanguard research made specific mention of the US stock market, which is by far the biggest, most well-developed market in the world. And if they're right, and the US does experience slower share price growth in the future, that doesn't automatically apply to Japan, or to China, or to Mexico, or to the UK. Stock markets are linked to a certain extent. The US market definitely impacts other markets around the world, but the world is a big place. Most of you listening to this will be UK-based investors. Did you know that the UK stock market only represents about 8% of world stock markets by value, right? That means 92% of all the cool stuff you can invest in resides outside the UK. And so we need to be careful of something called home bias. Just because we live in the UK doesn't automatically mean it's the best place to invest, right? And yet most investors, UK investors that is, are far too heavily weighted towards the UK. So-called emerging markets, places like Brazil, Russia, India, and China, can be very volatile places to invest. They can experience very high growth spurts, very big losses. The sort of point really of them being emerging is that their markets are becoming more transparent and more regulated over time. Transparency for investors is crucial, right? Because it engenders trust, that brings more money in, fuels growth for the future. But when we talk about emerging markets, we're talking about markets which are not to the level of the UK and the US and Europe and stuff when it comes to transparency and regulation. Behind the emerging markets, we've got so-called frontier markets. These are places like Egypt, Vietnam, Cambodia, Indonesia, Turkey. They're even more volatile and much more opaque than even the emerging markets, and certainly more so than the developed markets. This is not for the faint-hearted, investing in places like this. Maybe for a very small part of your portfolio, they could help fuel growth for the future, but caveat emptor. Those are, that's like the Wild West. That's why we call them frontier markets. Remember what I said last week about harnessing risk? We might need to get more comfortable with saving and investing in such places, even if it's only in small measures, if we're going to build wealth into the future, right? So we need to understand the risks and harness them where necessary. Third thing we need to talk about under what you need to know is the property factor. Okay, all this talk about shares, surely everybody knows property is the best way to build wealth, right? Well, if you were thinking that, right, that's lazy talk. Give yourself a good telling off. Property is without question an outstanding asset class. Its single biggest benefit, but also its Achilles heel, I think, if misused, is the ease in which you can borrow to invest. So, you can leverage other people's money to buy more property than you ever could on your own, and you can accelerate your wealth building that way. Fantastic. But things are turning a little bit. Assuming you're buying a property for investment purposes as a landlord, or maybe to flip it and make a profit, there are definitely fewer tax breaks than before. Stamp duty is punitive now. Capital gains tax is higher for property than for other asset classes, and you can no longer write off all your mortgage interest against the rent that you receive. So, the tide is turning against property investors a little bit. Still a great place to be, just slightly less attractive than it used to be. Also, property prices are relatively high. More on this next week, right? Even for investors. Of course, there are pockets of the UK where you can still buy investment property relatively cheaply, but rental yields are less than they were in many cases, all right? Actually, let's just pause a minute to explain the concept of yield, because for those of you getting started with investing particularly, that might be something you're not familiar with. Income yield on an investment is usually expressed as a percentage of the value of the asset. So let's think in terms of property as an example. If you owned a property conveniently valued at £100,000 and you get £5,000 a year rent from it, that's a 5% yield, because £5,000 is 5% of the £100,000 value of the property. If you don't increase rent over the years, right, and lots of private landlords fail badly at this, if you don't increase the rent properly and the property value rises, then the yield will fall in percentage terms. So if the property increases in value to an equally convenient £200,000, but the rent is still £5,000 a year, well, that's now a 2.5% yield, right? Still bringing in the same amount of money, but relative to the value of the property, it's a lower yield as a percentage. If prices rise, yields generally fall, and vice versa. That's a really important thing to understand when it comes to investing. When prices rise, yields fall, generally, and vice versa. So property isn't the easy win that it used to be. It's harder to get finance now than it used to be. The more punitive tax regime, I think, has been designed to cool off an investment sector which is in danger of becoming overheated. Obviously, for all things property investing, there's only one place you should go, and that's to my good friends Rob and Rob over at the Property Podcast and the Property Hub. You know those guys. Most of you listen to them too. So link to them in the notes. Property Podcast, easily one of the best podcasts in the UK. So 3 things we need to know. Firstly, we've defined what we mean by returns in the context of maybe having lower returns in the future. A reminder that the world is a big place and there's a whole load of value all across the world of stuff you can invest in. And then the property factor. Property is not panacea. It's not the answer to all our investing woes. It's an asset class even, one among many. It's great. It's unique. You need to understand it. It's not the panacea or even quite as attractive as it used to be. Excuse me, little cough there. So we know what we mean by returns. We've talked about the factors involved in determining those when it comes to shares and property and all that sort of stuff. What can we do, though, about all this? Armed with this knowledge, what can we do? Let's look at what we need to do next, after this little sound effect. There we go. Okay, first thing we need to do is not panic. Okay, this is more a don't do than a do, but you see what I mean. It can be really easy when we're talking about possibly lower returns in the future. It can be easy to maybe throw your hands in the air and just say, well, what's the point? I might as well just keep working forever and not worry about saving, live for today, all that sort of stuff. However, if you're listening to this podcast, you are clearly a person of excellent taste and discernment. Okay, you're not likely to fall prey to such negative talk. One thing I want to get across in this season is that not one of the challenges faced by millennials is insurmountable. Right? Each one of them can be overcome if it's approached with intentional thinking and by embracing some really good key financial disciplines, habits, and repeating them over time. Panicking is for lightweights. That's not us. So let's not be disheartened. We can do this. Okay, so let's move on. Don't panic that things might not be so good in the future. We can beat that. Second thing we need to do is to keep saving. Okay, keep saving. If it's true that returns might be lower in the future, then we need to focus on what we can do, because generally we can't impact returns. They're going to happen to us no matter what. We can keep throwing money into the system though. All right, that's what we can do. We're in control of that. Even if returns are lower than they were, investing in shares is still the best way we know to grow money for the future. Now, your savings rate, which is defined either by an amount in pounds or usually by a percentage of your take-home pay, is a key determinant of your future financial success. There is no correct savings rate other than as much as possible while you're still enjoying something of a life in the present. Some of you will be thinking to yourself, well, that's easily said, Pete, but I don't have a lot of spare money. I don't have any spare money, some of you are saying. I know that's the case for many of you, but don't fall prey to the easy response of, well, I can't save, right? Now, if, having taken a very clinical look at your spending, that is the case, then so be it. If that's the case, if you can't spend any less than you are currently, and as a result, you can't save anything, you only have one answer. You're going to need to find a way to earn more and keep your spending under control so that you can save money, right? Good cash flow is about money in versus money out. Spending less than you earn, I call it in the book and in various other places. Spending less than you earn comes in two forms. Either spending less, or if you can't do that, you need to earn more. Okay? Listen back to season 12, where I talked to six of my friends and myself, as daft as that sounds, about making money and how to do that. So, most of us, though, if we're really honest with ourselves, there is money that we waste, or that could be put to better use than it is now. I'm not going to fall back on the old sort of cliche of avocado toast and all that sort of stuff. I'm not even going to fall on David Bach's famous latte factor, right? Lots of other financial bods, including myself, have appropriated that over the time. You know, I really like coffee, and I can afford it, so I will buy it, right? Probably more often than I should, although I am bringing it from home more often now. But I also save a good proportion of my monthly income, right? So I am intentional about my saving and my spending in that order. And you need to be too. Paying yourself first, automatically increasing your savings rate over time is key to financial success. So determine how much of your income you will save this month and budget the rest. If you're going to get lower returns from investments in the future, you're going to have to be fairly aggressive with your saving. That's just end of story. There's really no other way to get around it. If you've got a good budget and you've got an emergency fund to protect against unexpected bills, then you should already have the money management chops that you need to find money to save each month. We just need to stop making excuses and get on and do it, right? If I point at you, those of you that are watching on the camera here, I'm pointing at you, but I got three fingers pointing back at me to tell me to do it too. Okay, we can do it. We just got to get serious. Third thing we need to do to counteract the impact of lower returns is to stack the deck in our favor by picking up any free money that's going. All right, free money sounds good, right? There are a couple of places you can do this to pick up bonuses, free money. The first is a lifetime ISA. If you're under age 40, you can have a lifetime ISA and you can pay into it until you reach age 50. You can invest up to £4,000 a year, right? And then the government will make up on top of that in the form of a bonus of 25%. So up to another £1,000. You put £4,000 in, they'll add £1,000. In a world of low returns, getting a 25% return on your money overnight is going to take some good beating, right? It just isn't going to happen. That's seriously good effort. Now, the lifetime ISA can be held both in cash. Don't do that. What's the point? Unless you're going to spend it in the very short term. And stocks and shares. Absolutely, you should do that. That's the best place to invest. It takes up part of your overall $20,000 a year ISA allowance, right? You've got to be under 40 and over 18 to open a lifetime ISA. Yes, I was right the first time. You can access the money no problem if you are buying your first home, or if you are aged over 60 and you're looking to retire essentially, or if you're terminally ill with less than 12 months to live, right? So buying your first home, aged over 60, or terminally ill with less than 12 months to live. If you take money out of a lifetime ISA for any other reason, you're going to pay a 25% penalty. Essentially, you're paying the government back the money that they've paid you and any growth on that money, right? So, as long as you accept that and go in with your eyes open, then that's fine. But it's free money. So if you're saving to buy a house, arguably the best place you can do that is in a lifetime ISA. $4,000 a year you can sock away and have it immediately made up to $5,000. So it's free money, so suck it up. Pensions, easily still the best place to pick up free cash, right? If you work for somebody else, you're an employee, there will likely be a workplace pension. You should join it. One of the few no-brainers in personal finance, just join the flipping pension and don't ask questions, just do it. You will get tax relief on the money, so the government essentially is adding to your pension pot. Your boss will contribute, your employer. Likely they will match what you put in to a certain extent, usually up to a certain limit. So let's, for example, say you pay in 4% of your salary, let's just say. And maybe your employer pays 3% and you get 1% tax relief as well. That means you get 8% of your salary paid in, but it's only cost you 4%. That's 100% return on your money overnight. Who cares about the markets, right? That is an epic ROI, 100% return on your money. You put in 4% and your employer and the government puts in. Even if you work for yourself, right? If you are a basic rate taxpayer, you're going to get 20% tax relief. So if you put in £80, the government will make it up to 100. If you're a higher rate taxpayer, you essentially are going to put in 80. The government will put in 20, and they'll give you another 20 quid off your tax bill. So it's really only cost you £60 to have £100 in your pension, a 40% overnight return. You know, this is significant numbers, and why wouldn't you harness this stuff? For more advanced investors, you can get tax relief in two other vehicles called venture capital trusts and enterprise investment schemes, but those are higher risk schemes and they're really beyond the scope of this season. For most of us that are looking to save and invest for the long term, the lifetime ISA, specifically if you're looking to buy a house, or for long-term sort of retirement savings, and ordinary ISAs, and especially your pension, those are the best places to sock money away. Simple as that, right? That's a fairly easy way to outpace stock market lower returns over time. Just suck up the free money. Fourth thing you need to do is to minimize cash. Minimize cash. Finally, if markets are not going to produce the returns that we've been used to, we need to make sure that every penny we can is put to the best use. And that means holding as little money in cash as possible. Long-time listeners, are you ready? Say it with me. Cash is not an investment. Say it again. Cash is not an investment. That means by holding money in cash, by which I mean money in the bank, right, in a savings account, is not the way to make money over time. Interest rates are low. They are likely to remain so for a long time yet. So chances are you're losing money to inflation by keeping it in the bank. So how much should you keep in cash? Well, I would keep your emergency fund in cash, obviously. Usually that's 3 to 6 months of expenses. Plus any money you're definitely going to spend in the short term, say in the next couple, maybe 3 years. So if you're planning a wedding, keep that money in cash. Big holiday or a new car in the next couple of years, keep that money in cash. Don't subject it to the stock markets. Keep it safe in the bank. Every other penny that you've got, though, not your emergency fund and not money you're going to spend in the next couple of years, every penny other than that should be put to work in investments. The difference is stark, believe me. You put 10 grand away today and you get a 6% return on it. Assuming inflation at 3%, then the real value of your investment in 20 years' time will be 17,500, just over, right? You've grown the money. That's the real value. That's in today's terms. You've grown the money ahead of inflation, increasing its buying power over time. Stick 10 grand in the bank and get 1% interest rate on it. Well, again, assuming inflation at 3%, the real value of your money after 20 years will be £4,110. You've lost more than half of the buying power of your money by leaving it in the bank. Say it with me again. Cash is not an investment. Really, really important. 4 things then. Don't panic, right? Future returns arguably, possibly being lower than they have in the past isn't the end of the world. We just put our heads down and do what we can. And we keep saving, right? We pick up the free money in tax relief where we can, and we keep as little money as we need in cash and put the rest to work. That's simple. I wonder if you're getting the message yet. We're 3 episodes in. Three episodes in to this season. While today's millennial generation definitely faces challenges, they are not insurmountable. Common sense, financial habits is the answer in almost every case. Understanding the maths behind some of the decisions we make with the money is definitely a factor as well. But if you embed these 3 habits, save regularly and increase your savings rate. 2, pick up all the free money you can, and 3, hold as little cash as you can, you're going to make great strides towards overcoming the challenge of lower returns on your investments. If indeed that does happen, and nobody knows. Okay, hope that's helpful. We can do this, folks. Here's a review by Beachcomber 8832 from here in the UK. None too shabby, says Beachcomber. I was introduced to Meaningful Money by a friend only 2 weeks ago. This is in October, so sorry, Beachcomber. It's taken me a long time to get around to this one. I've been binge listening to the Meaningful Money podcast ever since, and currently listening to the 2016 episodes. If you haven't listened to MM, start now. I am 52. And although I've always contributed to a pension, along with my employers over the years, it's only in the last year that I have taken any serious interest in my pensions, as my mind starts to think about when my exit from the rat race will be. Pete describes financial matters in a clear and concise way. He says it how it is. You can take the man out of Yorkshire, but not Yorkshire out of the man that knows. His outlook on life is honest and refreshing, making you seriously think about what the end game is. Good. The problem with pensions is none of us know how much we'll need. Will I need 50% or 2/3 of my salary? And the eternal question of how long for. Pete's podcasts are thought-provoking and give practical ways and suggestions of how to plan your financial future, advice on how to build your pension and build wealth, as well as highlighting tax-efficient ways of saving for the future and drawing in retirement. Now that's none too shabby. Thanks, Pete. You've become like a trusted friend. Beachcomber 8832. Thank you. It's a long review, but I really appreciate you taking the time to leave that. And good luck to you. 52, it's not too late. You can still make a big impact on your future. I'm sure you're going to be fine. But thank you for leaving that review. Massively appreciated. And if you want to do that, it really helps me out. meaningfulmoney.tv/iTunes. Or just go to wherever you're listening to this on and leave a review. That would be super helpful. Okay, a couple of things to mention. First is meaningfulacademy.com. This is something that we're building at the minute. It's not ready yet, but we're looking for 50 people to help us out as founding members that we can that can help us develop it into the kind of resources and tools that you want. It's basically going to be a site. It's going to be paid for. It'll have courses, resources, tools, video lessons, all that sort of stuff to help you take all this kind of things that we're talking about here to the next level and really embed it in your life. So we're talking budgeting help, debt reduction, all that sort of stuff. And in due course, as we build it, investment strategies and tools to help you review your portfolio, all the works, right? Taking the 2 courses that I've got at the minute and expanding them massively. Also, we're going to build in an element of community in that as well. So it's a work in progress, but if you want to help us out, you're not signing up to anything, you're not committing yourself, but go to meaningfulacademy.com, stick your name and email address in there, and we'll keep you posted as things progress. And maybe, certainly, the founding members are going to get a massive discount on the cost of entry. The other thing to mention is that we have a Facebook group now, more than 200 people in there. It's really growing, questions every day and answers from the community as well as me. I'm in there every day answering questions, and the folks in there have got some great experiences and some great answers to the questions as well. So I'm really enjoying that. meaningfulmoney.tv/community will redirect you to the right Facebook page. Just ask to join and we'll let you in. It's a really cool place to hang out online. Right. Next week, we're going to be talking about property and answering the question, really, is home ownership actually out of reach for most millennials? Is it something that belonged primarily to a previous generation or what? I'll be looking into that a little bit more next week. Remember, if you've got any questions when it comes to today's show, do that at the show notes, meaningfulmoney.tv/MF3 for Millennial Finance 3. Generally, though, if you've got any questions, if you've got something you want me to answer on 5 Minute Friday, go to meaningfulmoney.tv/askpete. Leave me a voicemail, send me an email. That's the place to go to do that. And I think we're just about done for this week. Hope you enjoyed it, and hope that you're getting benefits so far from this season. Do get in touch. We have an email address, actually. I haven't mentioned that in previous episodes, which you really should do that. Season13@meaningfulmoney.tv if you've got any questions on it. All right? Anything related to this season, email season13@meaningfulmoney.tv. Thanks for listening, folks. I'll talk to you next week.